Welcome back to Small Caps, ladies and gentlemen. My name is Kerry Stevenson, and today we're going to talk all about gold. I've asked Alex Scanlon. He is the Managing Director and CEO of Barton Gold Holdings. ASX code is BGD, and Alex knows I once got that wrong. I will never get it wrong again. BGD. Now, they've got gold, South Australia, 2 projects, lots of drilling going on, a big vision for the future, and a lot of news flow. So I'm really excited. The last time Alex and I spoke on Small Caps was a year ago. You can go back and have a look at that one, but they IPO'd about 18 months ago. I think I'm right, Alex.
That's right.
And they have done a lot of work before the IPO even. They spent about $8 to $10 million just in finding out what it was they've got. They're in a really interesting area, but I'm not going to tell you the full story. I'll let Alex do that. Alex, great to see you. Welcome back to Small Caps.
Thank you for having us.
Because it's been a while, let's do a brief overview of who are Barton Gold, and then we'll get into the news and what's happening right now.
Sounds good. Look, really high level for those who either haven't been following it for a while or just as a brief introduction. Look, going back to 2017, we looked out across a world that we saw as very troubling, both in terms of sort of geopolitical trends, in terms of monetary policy risk, and in terms of corporate, consumer, and sovereign credit risk. So we were really looking at how do we put together a very large, very interesting gold development play in an untapped jurisdiction. And of course, in Australia, the traditional homes of gold mining tend to be Western Australia, tend to be Queensland. We looked out and did a lot of research, and we actually realized there was essentially a forgotten gold district in South Australia. And South Australia is a state that does host about 25% of Australia's known gold resources, but only accounts for about 2.5% of Australia's annual gold production. So there's a very strong mismatch between historical work and contemporary work. So looking at the central Gawler Craton, right in the heart of that central Gawler Craton, there is the Central Gawler Gold Province. And there was a huge rush of interest in 1995 and 1996. 2 of the projects that we own bookend that district. There was a huge rush of interest because both what became the Challenger underground mine and the Tunkillia project were discovered within 6 months of one another. And everybody got very excited just in time for the gold market to crash in 1997. And then when you fast forward 10 years, when the gold market came back and the gold price started getting to $700 and $800 and $900 US, everybody starts coming back into gold investment. But what happened was nobody went back to South Australia. Everyone went back to WA. Everyone went back to Queensland. Nobody went back to South Australia because there was not really this critical mass of interest and investment at that time. However, there was a huge amount of data generated during the 1990s that we got into. We leveraged, we identified that not only were there existing known resources and large scale exploration upside, but that we could essentially acquire and consolidate the majority of this district, the majority of significant historical producing and exploration ground. And so we did that. And so in the time since then to IPO, we consolidated about 5,000 square kilometers of tenements. Before we IPO'd, we undertook a number of resource updates. So we built a 1.1 million ounce resource base, and we own the only gold mill in the region. And in this time now, we've had a number of people coming in around us to really jump into this gold exploration story. We're seeing a lot of sort of tailwinds and sort of government interest and support and involvement. In the 18 months since we've listed, we went out, we set out in our prospectus, of course, this is our thesis. This is what we know. This is what we think about how it grows. And our principle here is not to try to rush back into operations, but really to step back, take a much bigger picture, and embrace the upside potential. Really look at this large scale development potential. In this time, we've brought in a lot of new technology to really accelerate our understanding of the region from the mid-1990s. We have gotten almost $1 million in co-funding support from the South Australian government to do that. We have discovered 4 new gold zones for more than 2 kilometers of new gold mineralization. And we've now really crystallized our leadership team around South Australia. So we've built a team that has substantial Australian gold expertise and substantial South Australian operational expertise. So we're really building and continuing to reinforce a very strong platform for large scale development, because our objective, which we're now sort of communicating to the market, is that based upon what we have, but also how we see it growing, we want to be producing 150,000 ounces per annum within 5 years. And then we also see opportunities to actually bring forward a subset of that production and use our existing infrastructure to start sort of stage one operations. So we've built this platform, are very systematically laying out a roadmap to large scale development, and one that doesn't require us to try to sort of jump a huge chasm all at once.
Thank you. That was a really good overview. One of the things I wanted to ask you, Alex, and just listening to what you're saying is, you mentioned Queensland and Western Australia. There's a lot of gold companies out there. Mm-hmm. To our audience that are listening, what do you think sets Barton Gold apart from all the other noise out there?
Well, look, I mean, there are some very good companies out there, right? Some companies that are led by really, really good exploration geologists, discoverers, developers. I think one of the things that does set us apart on the strength of our platform is a clear focus and clear strategy that not only is exclusively focused on gold. We don't split our focus between gold and rare earths, or gold and nickel, or gold and copper, and we're not split in focus between different regions. So we are pure play gold, pure play South Australia. We have a clear roadmap to follow, and along that roadmap, we have a clear destination, right? So we intend to develop these assets. We are working on building large-scale open pittable mineralization, okay, which is not so technically difficult. We're not focused on high-grade underground. So we are looking at something where we're actually trying to establish a significant but achievable objective, and then mitigate risk along the way, and just systematically take ourselves to delivering that. Another thing that sets us apart is we do have some sources of income, which also offset a lot of our expenditure. It's something that is a bit of an advantage for us. We have surplus assets and equipment in and amongst this huge platform of infrastructure that we've acquired. Many of these pieces of equipment and some of these assets are surplus to our requirements, even for the next 10 years. So we can dispose of these. We've had gold concentrate sales from our mill. So we're doing things a little bit differently, but certainly moving very aggressively in the right direction.
Yeah, and it's when you talk about infrastructure, you've got the only gold mill in the area. I'll come on to that in a moment, but you've sold some gold from the mill. Is that what you said, to ABC?
That's correct.
So what sort of numbers are you looking at there? What did that bring into Treasury?
So in June of this year, so June 2022, we sold about $1 million worth of gold. Okay. And so that was about 380 ounces of gold. And that was only a portion of the gold that we recovered from the mill. So we still have another portion of gold that we will sell from that. We are also going through and sort of continually evaluating, is there the ability to extract more gold from some of our other stockpiles and assets? So it's obviously not a priority focus for us. The priority focus is large scale resources growth, but these things obviously are nice in offsetting income and protecting our shareholders from the need to consistently go back to market and dilute shareholders.
Well, just briefly, because then I want to get really into, if you like, the resources and the drilling and what you're doing there. But you've inherited some camps, you've inherited some other bits and pieces that you say are surplus to requirements. Is that going to be easy? It doesn't take your eye off the ball, I guess, is what I'm saying. But it does, I guess, give you a little bit more income, so you don't constantly have to go back to shareholders because you've got a solid balance sheet.
Correct. Yeah, we had $10.3 million as of the 30th of September. So we raised $15 million at our IPO, and that was 18 months ago. We still had $10.3 million as of the 30th of September, and that's because of this income that we've had, while aggressively but carefully spending money on exploration. And you're quite right. It's, our objective is to be very focused on exploration, make sure we don't take our eye off the ball in terms of our exploration activities. But we have essentially a parallel corporate development and parallel resource development focus that we're balancing quite nicely.
And as I say, we will get into the drilling that you're doing, et cetera. But I think it's really important just at this moment to say that your background is pretty important here, because you understand the sort of the balance sheet and treasury, because you've got a finance background. Can you just give our viewers a little bit about your background? Because I actually think that's pretty important when you're running this sort of a company.
Yeah, like my background is a combination of economics, principal investment, structured finance, and that's been both on the principal investment side and corporate advisory side. So I think when we look at things and we look at, what is the tool set with which we are working, we are casting an eye across it very much as though we are credit investors, right? We're looking for what is the value that we can extract from existing assets while adding long-term value to the development proposition. I spent several years doing restructuring and refinancing of resources businesses, but also resources services businesses. So, it's sort of a systematic process of building a concentric circle of understanding and relationships around the resource asset, not just the asset itself, but service providers, the people financing those service providers, understanding where value slips through the cracks, particularly on an operating mine site, where there may be excess in purchases that you can extract from that site in terms of surplus equipment. And then also looking at how you can optimize the financial approach to things. So we are fairly careful on that front, and we do cast a good amount of attention to figuring out, can we arbitrage the cash that we otherwise have to post as a bond for our assets? And the answer is yes. We've found a way to arbitrage a bank guarantee cost versus a cash yield on those securities that we otherwise post. So we're generating going to be about $100,000 per annum in terms of yield just on the bonds that we otherwise have to post to the government. So this is all very helpful, and $100,000 is in and of itself not an altogether large sum of money in the context of the programs that we're running. But when you're doing 5 or 6 different things like that alongside some more significant initiatives that generate $1 million here and there, it really does start to add up. And that does translate through to, that's that $5 million capital placement every 6 months. You can start to remove 1 or 2 of those, and that's dilution that shareholders then don't have to suffer while you continue to build the story along the path towards a much larger revaluation as you get towards development and operations.
I think it was just very important for people to understand that as we go along. Let's go into that sort of development of the project. You've got Tunkillia and Tarcoola, and let's talk about Tunkillia first, and we'll come on to Tarcoola. What have you been doing there? Lots of drilling. I think you've got I think you set out a 9,000 meter drill program, but you've expanded that to something like 17,000 meters. Is that correct?
Yeah, so we announced we announced the 9,000 meter drilling program at the beginning of September, and we started that immediately after discovering yet another new gold zone there, which was the Area 51 gold zone. So that is a new gold zone. It's coincidentally named after an actual drill hole number. But we discovered that new gold zone. We started a drilling program, and the objective there is to actually grow the existing deposit there, which is the 223 deposit. That's a 965,000 ounce resource. And then also to potentially bring that new gold zone into resource itself. And that's significant because when we think about the history of this deposit, very little work has been done on this deposit in terms of drilling and growth and thinking about its potential for the past 15 years. That 965,000 ounce deposit is based upon drilling, which mostly was done before 2008 and below a gold price of $800 US per ounce. So in a modern setting, in a modern context, that means it had a fairly restricted search domain in terms of drilling only to a very shallow depth because the gold price could only get you so far. So the asset itself sort of sat in stasis for a long time. We've come back in and we've not only proven that there's actually a higher grade central zone inside that same deposit, which makes the development proposition far more interesting. We believe that deposit will grow, but we've also stepped out now and established a much larger footprint. So 3 new gold zones there show us fairly conclusively that the gold endowment of this project is far more significant than has historically been understood. So we're essentially kind of breaking away from, what was understood in the past to establish a much larger platform for much larger development.
And when you say so expanding the footprint out, how deep have you done the drilling? What sort of grades are you getting? Because I think one of the things that you've said is that you're looking at a large open pit rather than underground. So to help us understand what this looks like, how deep is the drilling been? What sort of grade?
Yeah, look, the drilling depth historically has been variable. So drilling has gone a little bit deeper where higher grade shoots have been found. What we've been mapping out is what we believe may be one or more sort of higher grade trends that sort of go to depth. But if you consider the average vertical profile of the mineralization in this deposit, so from the average top of mineralization to the average bottom of mineralization, that's only about an average of 125 meters depth, which is really quite shallow. So the extensions of the mineralization have been very poorly tested historically because of low gold prices. So to come back to your question, when we drilled the center of the deposit, one of our drill holes had a combined about 44 meters of mineralization at close to 3.5 grams per ton, which is considerably higher than the overall resource grade of 1.15 gram per ton. But in the context now, talking about a large scale open pitable development, when we look at broad, highly continuous mineralization, a 1 gram per ton open pit can be very, very attractive. And there are developers in Australia which are now demonstrating this really for the first time in the Australian context. Capricorn Metals being a very good example with the Karlawinda project. That project has just now come through 12 months of commissioning and is operating at a sort of a full-scale production rate of around 120,000 ounces per annum. Now, their deposit is about 2.3 million ounces at 0.7 gram per ton.
Oh, wow.
Also with the benefit of some higher grade zones throughout the deposit, as we've been demonstrating at Tunkillia. The result is that their average head grade is around 0.92 or 0.94 gram per ton. Now, they are producing 1 ounce of gold at less than 1,200 Australian dollars per ounce, which makes them the cheapest pure gold producer in Australia off a 0.7 gram per ton resource. So the economies of scale, the efficiencies of scale in these types of large scale continuous deposits can be quite significant.
And I think it's also important to point out that you said lowest cost in Australia. Ladies and gentlemen, $1,200 per ounce cost, I'm assuming that's all in sustaining costs.
Yeah.
With a current gold price in Aussie dollars of about 2,600, and it seems to be getting a bit stronger. That means it's just spitting out a lot of cash. What's their market cap? I'm just curious. What's their market cap?
I think right now they're about a $1.8 billion company on that 120,000 ounces production rate. So they've really obviously nailed the case for these types of deposits. And interesting to note, the team that has done that for Capricorn, this is actually the second time in a row they've done this. So this is not an accident. They did this at Regis as well. So it's very interesting because it's the first time that perhaps the Australian market is sort of seeing this style of development thesis, whereas traditionally the sort of the big stories that we hear of in Australia are focused on sort of deep, high-grade underground mining, which certainly has its merits, but it's also far more complicated and far more costly, both in terms of exploration and development and operations.
So just thinking about that at the moment, because I want to talk a little bit about capital structure, then I'll come back to the deposits again. Sorry, we're jumping around a little bit, but I think it's important. You said Capricorn 1.8 billion. The average grade's about 0.7, but when they put it through the mill, about 0.9. But your market cap, and I know you're not a producer yet.
Yeah.
There's a very wide gap. And I'm just wondering, do you think the market doesn't understand what you've got your hands on, or you haven't been talking about it? I'm just curious because it seems a massive gap, even though I understand that they're now in production, spitting out a lot of cash. There is a difference there.
Yeah, look, we have a pathway to walk, but I think that the really interesting thing is we have a pretty clear pathway. We have a pretty clear destination, and the strategy to get there itself is quite clear. So, yeah, I mean, our enterprise value today is around $25 million Australian. That's reflecting a $35 million market cap and $10 million cash in the bank.
Sure.
You know, our objective is to be producing 150,000 ounces per annum, and our average resource grade is 50% higher than the resource grade at Karla Windows. So, you know, certainly if we can emulate that project, I think we're in a very good position as we move forward. And then the question is, you know, how do you move up that value curve? You know, what are those key points? What are those sort of key catalysts and key points? For us, it's about making sure we had the foundations right. We think we have that in place. We have that established. And now we're shifting into a little bit more of a forward-looking stance where we're saying, look, that is where we're going. This is what we're doing to get there. Here is the momentum that you can see. In our case, we've spent the past 18 months proving the geological thesis, and now we're shifting into resource growth and sort of forward development thinking. So these 14,000 meters of drilling that we have underway now, which, as you mentioned, is started as 9,000 and then twice expanded, this will inform a resource update in March of 2023. So we'll have about 14,000 meters of drilling results coming out December, January, February, and March. And that will give investors a chance to see for the first time in a modern context, the growth in this mineralization and sort of a pathway to that type of 2 million ounce scale that can then put us in the same sort of development bucket or development thesis as trying to emulate the Karla Windows success.
It sounds pretty exciting. I want to talk about that. What are those milestones? You said resource update March of next year. I'm talking to you in December. That's not very far away. So is that more drilling, more results coming out, resource update to follow? Correct.
So yeah, drilling results December, January, February, March, a resource update targeted for the end of March. And then that will set us up, you know, as we have sort of developed our exploration thesis, that will then again just tell us, okay, now we think we can keep going this direction and try these new assets for further resource growth. So the objective is to, you know, one, we grew the resources prior to IPO. Then at IPO, we set up our thesis. We've now validated that thesis in multiple different places. We want to grow the resources, and then we want to grow them again, hopefully by the end of 2023, and show people, okay, we can now be comfortable that these are going to keep growing. The mineralization keeps going, and now we're going to start thinking about taking that step towards development planning. So feasibility studies. That's all around Tunkillia, though, isn't it? So we were talking in the context of Tunkillia. Yeah. But a development study, the development of Tunkillia would go hand in hand with the development of Tarcoola. So these two assets are only 70 kilometers apart from one another. So they actually are satellites to one another. And again, in the modern context of large scale operations, we are the first group to own those assets together, to view them as a co-development proposition, right, and to invest tens of millions of dollars in advancing that proposition. The great thing about Tarcoola is that, you know, this was the site of the South Australian gold rush in the late 1800s. So the same time as the Kalgoorlie gold rush in Western Australia, you have the South Australian gold rush, and that happened right in the heart of our Tarcoola tenements. There's about 600 historical workings there, which is this very shallow, scratching out quartz, you know, high grade quartz hosted gold. But these guys were mining gold at over 1 ounce per ton, so between 30 and 50 grams per ton. Wow. There has never been any modern systematic work explaining where all of these high-grade shoots of gold are coming from on surface until we've come in. And so we have an existing high-grade pit there that was producing about 3.8 gram per ton during 2018, and that was going to our mill. So we think we can replicate multiple high-grade resources like that. They would then act as high-grade satellite feed coming into the Tunkillia project. Right. That would further average up the feed grade. But the benefit of Tarcoola's placement being to the north of Tunkillia is twofold. One, when we build a large new mill at Tunkillia, for this, large scale baseload development, we can then basically just send ore from Tarcoola down to Tunkillia, and that's only about 80 kilometers driven. But in the interim, Tarcoola is actually closer to our existing mill than Tunkillia is. So we have
let me stop you for a second, because you've got an existing mill, and I think you just mentioned building a new mill. Am I
correct?
Oh, okay.
Yeah.
Explain that to us.
The really big picture, so that 150,000 ounces per annum is based on building a new mill at Tunkillia, because that's really large scale baseload mineralization. You're going to get far better efficiencies out of having a new mill there than trying to truck low grade material a long distance. But the existing plant that we do have, it is a smaller plant. It's a 650,000 ton per annum plant. That plant has processed ore from our Tarcoola project quite recently, and done so with sort of 94.5% recoveries. So it gives us the ability to sort of form the big picture and clearly put ourselves on that development path, but then to also leverage our existing mill and higher grade mineralization at Tarcoola into a stage 1 operation, and essentially turn that into a little bit of an internal ATM and cash flow that helps us fund the development of the much, much bigger picture. And therefore, we're not actually taking the risk of jumping all the way from 0 to a target of 150,000 ounces. We're not just an explorer proposing to become a major producer. We sort of turn ourselves back on, if you will. We turn what we have back on. We become a producer. We generate cash flow. We have real security value. So when we're talking to equity financiers and credit financiers, we have a very, very different profile and a much stronger base or footprint on which to step forward into becoming a much larger scale producer.
What sort of cost would something like that new mill? Have you got an idea of the cost of putting a new mill in there? Number one. Number two, would that mean you sell the old one, put the new one in, so there'll be a little bit of a balance there?
Look, we obviously need to complete a proper feasibility study on what the cost of a mill would be, but I would imagine, we're going to be looking at a more significantly sized mill, so somewhere between 4 and 6 million ton per annum. I would imagine that this is something like a $250 million development, right? So not the biggest development, but not insignificant. Now, we would look to supplement the equity portion of that development by generating income from a stage 1 operation.
Yeah.
The benefit is, of course, we already have that mill. We don't need to think about building a $100 million mill to start stage 1. We just need to turn our existing mill back on. So it's a very nice drawbridge to cross compared to many people who are out there looking at developing a new plant as a general start. But realistically, we would keep that other mill, the original mill that we currently have. The reason being that once we start sending the higher grade ore from Tarcoola to Tunkillia, around us, so within 50 kilometers of our existing mill, there are a number of juniors exploring and a number of resource bodies that we could then look at absorbing those resources. Whether that's through M&A, whether it's through toll milling, that's a very attractive proposition. What is equally attractive is maintaining sole ownership of all processing infrastructure in the region, because then you not only have leadership in terms of regional resources, you not only have leadership in terms of regional production, but you also have leadership in terms of regional infrastructure, and you're an infrastructure company and a gold producer. And that's a very, very strong position to be in for a very long time.
Oh my goodness. It's been such a great, we've actually gone over time, but there was so much to get through here, Alex, in a very succinct way. People love this. Just wrap it all up in a bow, if you like, and give us 3 reasons that we should be looking at Barton Gold right now.
Well, firstly, as we've discussed, we have a very humble, a very reasonable enterprise value of about $25 million. Our 5-year vision to be producing 150,000 ounces per annum would suggest that there is a lot of upside to be realized between now and then, and for those who come into the story today. And when we look at what that upside is, number 2, our development hero, if you will, is, really the guys at Capricorn Metals. That is a $1.8 billion company on the basis of 120,000 ounces per annum on a project that looks like a bigger brother to our Tunkillia project. So we've got a pretty clear picture of where we want to go, and we've got a lot of momentum currently underway to get there. And then three, for anyone who's looking at this, they're also just looking at the gold market generally, right? It's been a tough time for the past 18 months for gold, but really, it really feels like all of the market factors are coming together for gold. I think the timing is really interesting to start looking at what gold stories do you want to get into. I think we're going to have a very strong 2023 and 2024 ahead. And it's really a good opportunity to take a look at Barton, get familiar, get set, and be in position ahead of a huge amount of news flow.
And I'm sure that Alex Scanlon would be absolutely fine if you had some extra questions. But look, I think that was a fantastic overview and a bit of in-depth about what you're doing. There's a clear vision there. And as you say, the 5-year vision is to become a 150,000 ounce a year producer. And the interesting thing for me talking to you is that sort of large scale open pit, very cost effective, been done by Capricorn Metals, and prior to that, others. Could be a very interesting time. Good luck, Alex. Thanks so much for joining us on Small Caps. Come back post-Christmas and let us know how things are going with all the news flow.
Will do. Thank you.